Welcome to the explainer. So you pull up a financial chart, right? And it just looks like this chaotic, confusing mess of red and green lines jumping all over the screen. Well, today we're going to completely decode that matrix. We're going to transform how you view these charts by framing them exactly for what they are, an epic, ongoing tug-of-war between buyers and sellers. Because by the end of this explainer, you're not just going to be looking at random shapes anymore. You are going to be reading the raw, unfiltered psychology of the market. Let's get into it. Here's our roadmap for today. We'll kick things off with the samurai's trading secret, break down the anatomy of a candlestick, introduce the three core archetypes, level up to some high probability power patterns, and then wrap it all up with trading in context. All right, section 1, the samurai's trading secret. We're talking about Hanma Monahisa and the Dojima rice market. To really get a grip on market psychology, we actually need to travel back in time to 18th century Japan. Listen to this quote from Hanma Monahisa. He's widely considered the father of candlesticks. He said, "When all are bearish, there is cause for price to rise. When everyone is bullish, there is cause for price to fall." That echoes the greatest modern investing legends, right? And it establishes this fundamental truth. Trading isn't just about the math, it's fundamentally about anticipating human emotion. So what exactly is this tool that Hanma helped inspire? Well, a candlestick is simply a visual chart component. It displays the open, high, low, and close prices for a specific period of time. But really, ultimately, it's a reflection of a fierce battle. It's a battle for control between the buyers who want to push the price up and the sellers who are trying to drag it down. To put Hanma's legacy into perspective, the Dojima rice market transitioned into a futures exchange way back in 1710. Hanma was born shortly after in 1724. And get this, he became so incredibly successful at reading the psychology of the rice markets using these visual patterns that he was actually honored with the title of samurai. I mean, that's amazing. These behavioral patterns have been successfully tracking market psychology for a very, very long time. Moving on to section 2, anatomy of a candlestick. Let's decode this red and green battleground. Okay, so we're zooming in from that historical macro view right into the microscopic DNA of market movements. And this brilliantly illustrates the core difference between the two combatants in our tug-of-war. On the left, you've got a bullish candle, usually green or white. It opens at the bottom of that thick rectangle, which we call the real body, and it closes at the top. Basically, the buyers won that session. On the right, we have a bearish candle, usually red or black. It opens at the top and closes at the bottom, meaning the sellers drove the price down. Now, quick irony alert for you here. Historically speaking, trading has been a heavily male-dominated industry, right? Yet the default colors chosen for these charts are red and green. Considering something like 19% of men are red/green colorblind, those are literally the worst possible colors they could have picked. Fortunately, you can customize chart colors on pretty much any modern platform today. So, the absolutely crucial point here is understanding the 4 key data points that every single candle gives you. The thick real body plots the open and the close. But see those little thin lines poking out of the top and the bottom? Those are the wicks, or shadows. The tip of the upper wick shows the absolute highest price the battle reached during that time frame, and the bottom wick shows the absolute lowest. Think of wicks as rejected prices, areas where one side pushed hard, but the other side just pushed back harder. Section 3, the 3 candle archetypes. We're looking at strength, control shifts, and indecision. Look, you do not need to memorize hundreds of confusing, complicated patterns. You really only need to know these 3 main characters in our candlestick story. First up is the strength candle, often called Amarabozu. It's got a large body with tiny or maybe even no wicks, which means uninterrupted control by one side. Second is the control shift, or pin bar. It has the small body but one massive wick, showing that one side tried to take over but was violently rejected. And third, the indecision candle, the doji. Tiny body, wicks on both sides. It's an equal fight, no clear winner yet. I want you to pay close attention to the concept of zero for a second. If you see 0 wicks on a massive strength candle, a true Marubozu, it means there was 0 resistance. None. It was a complete and utter steamroll by either the buyers or the sellers from the exact second the period opened to the very second it closed. But on the exact opposite end of that spectrum is the doji. This represents pure, unadulterated indecision. A true doji opens and closes at the exact same price, so it looks just like a little plus sign. It is the ultimate sign of a paused battle. When you see this on your screen, the market is basically taking a breath, letting traders know, hey, wait to see who makes the next aggressive move. Let's level up. Section 4. High probability power patterns. Time to read the multi-candle story. Alright, so now we're shifting our focus from single candles to how they actually interact with each other. First up is the engulfing pattern. This represents a sudden, violent takeover in our tug of war. A bullish engulfing happens when a small red candle is followed by a massive green candle that completely eats the previous day's body. It essentially wipes out all the seller's recent progress in one single swift move. A bearish engulfing, exact opposite. A massive red candle totally swallowing the prior green one. Next is one of my personal favorites, the morning star reversal. Think of this as watching a U-turn happen in slow motion. Step 1. A strong red candle pushes the price down. Step 2. A small doji or spinning top forms, signaling that the sellers are getting exhausted. And then, Step 3. A strong green candle surges up, closing at least halfway up that first red candle. The sellers ran completely out of gas, and the buyers just took the wheel. For a really powerful continuation pattern, you've got to look at the 3-line strike. Imagine an ongoing downtrend. Suddenly, you get 3 small green candles slowly creeping up, kind of looking like a reversal, right? But then, bam, one massive red engulfing candle prints, wiping out all 3 of those green candles instantly. It tells you the dominant market force was literally just taking a quick breather before totally crushing that temporary pushback. Finally, Section 5. Trading in context, because honestly, patterns mean absolutely nothing without the bigger picture. If you take away anything today, let it be this. Hunting for candlestick patterns in the middle of nowhere is a massive trap. A pattern only matters if it aligns with other essential contextual clues, which we call confluences. You need to spot these patterns at key support and resistance zones. You want to see multiple candle wicks repeatedly rejecting off of a specific ceiling or floor. You want alignment with trend lines, and you always want to confirm your thesis on a higher time frame, like a 1-hour or daily chart. The more confluences you have, the higher your probability of success. You also really need to contextualize momentum, and the cool thing is, momentum loss is incredibly visible. Just watch for shrinking candle bodies and widening wicks as a trend progresses. Like if you see 3 green candles in a row, but each one is significantly smaller than the last, and those upper wicks are getting longer and longer, it literally paints a picture of the buyers running out of steam. The dominant force is getting tired. Okay, let's tie the whole shebang together into the professional's workflow. Step 1. Identify a key level of interest on your chart beforehand. Step 2. Wait patiently. Seriously, don't chase it. Let the price come to that exact zone. Step 3. Look for one of our candlestick archetypes, like a massive control-shift pin bar, to actually confirm the market is reacting to your level. And finally, Step 4. Execute the trade, but always protect yourself with a clear stop loss. Which brings us to our final thought. The very next time you open up a chart, I want you to ask yourself, are you just staring at random red and green shapes, or are you finally reading the psychology of the market? Now that you know the real story about the wicks, the bodies, the exhaustion, and the takeovers, you are literally never going to look at a candlestick the same way again. Thank you so much for joining me on this explainer. Keep reading those charts, and I'll see you next time.
This image is for illustrative purposes only. To gain a deeper and more structured understanding, join my community where you will have access to comprehensive materials and detailed guidance.